What is up, everybody? It's Austin here with We're Talking Finance. Appreciate you sticking around, coming back. I know it's been a while since I have posted anything. My apologies. I've been actually really busy with work. Like I said in some of my previous videos, I do a lot of business consulting for marketing, branding, etc. But anyways, doesn't matter. So over the past week, I had an opportunity to sit down with this fella named Brian, who is with a company called Lender Financial Services. And we were talking about credit scores and all kinds of really interesting things and how much misinformation is spread to the consumer from the bureaus and why. And it makes a lot of sense. And so I kind of had this idea, wanted to do like an interview series. So I asked Brian if we could sit down and film a short interview. He agreed. And here it is. I'd really appreciate it if you would subscribe to my channel or like a video, comment. Good or bad. And yeah, so I really appreciate the support, and all of you that are out there and watch and support, greatly appreciate it. So without further ado, let's get into We're Talking Finance interview edition. What's up, everybody? It's Austin. We're Talking Finance. We're going to do something a little different today and talk about credit. And I have an expert here with us. This is Brian. And we're going to talk to him about some rather uncomfortable things that might help you out. All right, Brian. Tell me some common credit score myths that, the majority of people believe that in your, profession and expertise, you've come to find out are actually not reality.
If you find if you can look at your credit score on your phone and it updates daily, it's not a real score.
So that'd be like your Credit Karma.
Karma, Credit Sesame, Credit Wampum, Credit whatever. Not a real score.
So then what is the real score per se?
The Fair Isaac Corporation's mortgage algorithm can be found on, now Experian has it, you pay $24.95 a month and they'll give you your real score once a month. But if you're going to do that, so it's a FICO score, but they get it from the FICO. So you can go to myfico.com and spend $39.95 a month and get all three real credit scores, but they'll also give you 9 other scores that aren't relevant to you. So if you can get your score on your phone and it changes every day, it's not a real score. So you either get it from your lender, banker, mortgage, auto, or you get it from myfico.com. And then when you get it from myfico.com, you got to know which one you're looking for, because there's one that you're looking for and there's 9 that you're not. And the one, if you get the MyFICO app, and that's the FICO 8 score, which is so junky you can see the needle marks. It is designed to go up and down like a flag on a flagpole to create panic, to frustrate you and confuse you so that you will buy additional credit reports in between the ones that you've agreed to buy every month that come on the same day every month, like the 12th or the 19th or whatever.
So basically these are companies that will be like, so the concept. So and I think GoPro kind of ran into this also. Let me turn this mic sensitivity down a little bit. Technical difficulty time. So like the company GoPro, they kind of had to come around because their first product was so awesome it never broke. And they did not need anyone to buy more of them. So what you're saying is these, check your credit score every day. What they're doing is creating something that gives the perception of, oh, well, I need this.
They want to be your expert. What do I do? What do I do? Here, try this. It's not very expensive. Everything on the Credit Karma site, if you click on it and get that product or service, Credit Karma makes money. Credit Karma is free to you, but you pay for it because they're parting you out like they're harvesting your organs. So if you have $3,200 in charged off credit card, One Main Financial is going to send you an email that says, hey, we'll do a loan for $3,200. Well, how'd they know how much you owed?
It makes sense too, because if what we get is free, then chances are we're the product. Like social media cats out there, Facebook is not free.
Yeah,
that makes a lot of sense.
Yeah.
So how do they calculate the FICO? Like what it is, because that
30,
seems to be
30, all right, mortgage FICO. There's lots of FICOs. Software algorithms assign weight to data. So every breath you take has a risk assessment and value assigned to it. So Credit Karma, when they're saying this is your score, technically they're not lying to you, but they're also misleading you. Like that's not the mortgage score. They're more black and white. Like they'll tell you if you pay a collection in full, your score will go up 25 points. If you get it deleted, it'll only go up 23 points. All right, that's true for their algorithm, but it's not true for the mortgage algorithm. If you get 3 6-year-old collections deleted, your score might drop 2 points. If you get a collection deleted from last month, your score might jump 50. So but the entire banking world stakes there because every credit score has a risk assessment and value assigned to it. They know how many people are going to default that have 800 credit scores. They know how many people. It's like insurance. They know how many steps a smoker is going to take before they have a heart attack. That's how they base what fee you pay because they're not going to lose money. They're not in the business of losing money. So every credit score has a risk assessment value assigned to it, and interest is risk-based pricing. So the lower the risk you are, the lower the rate. The higher the risk you are, the higher the rate. A loan at 640 is cheaper than a loan at 620, but a loan at 680 is a lot cheaper than a loan at 640, and so on all the way up. There are no price breaks after 740, but there is that wow factor. Ooh, 800. So the mortgage algorithm, how they assign weight to data, 35% of your score is if you pay your bills. It's payment history. And your payment history goes from today until 7 years ago from today, because after 7 years, the date of your last payment is when it falls off, 7 years. So if you draw a line from today to 7 years ago today, whatever hits closest to today, good or bad, carries the most weight. So something that happened in 2018 is important. It's just not as important as what happened in 2021. So when we're settling debt, if we have a huge collection from 2016, you have $10,000 in collections, 9,000 is in one collection in 2016, and the rest of them are collections, of under 1,000 divided by 6 or whatever. Those are the ones that we take care of. You still have a $9,000 collection, but it doesn't hurt you nearly as bad as these little ones that happened in 2021. So that we want to get to zero bad debt. We just don't have to do it all at once. Your score can rise even though you have bad credit. So 35% of your score is if you pay your bills. 30% of your score is if you have a credit card. You have to have, if you don't have a credit card, you're missing out on 1/3 of your scoring opportunity. 15% of your credit score is length of credit history. If you have a 1-day-old credit card, it's helping you, but a 9-year-old credit card is really helping you. That's how you bulletproof your score.
Is that regardless of the credit limit on that card?
No, it's not about limit. It's not about amount. A $100 credit card gives you as many, properly managed, gives you as many credit points as a $100,000 credit card, properly managed. Your credit report doesn't know how much money you make. It assumes how much money you make by how you manage your balances.
So would 2 properly managed small balance credit cards, then would that be better than 1 properly managed large balance?
4.
4.
Yeah.
Why is that the magic number?
Well, because 4 pieces of credit, 24 months old or older, gets you to the front of the line in conventional lending. Like conventional lending means loans without mortgage insurance. Conventional lending means business banking, small business banking, investment loans. They want to see that you've handled multiple accounts over a period of time. Your credit score is like your grades in high school. If you make an A on a paper, you made an A on that paper. If you make an A on every grading opportunity that semester, you made an A in that semester. If you make an A every semester, you're an A student. Therefore, the college can assume that you're going to continue to be a good student. Same with credit scores. But people give up so fast. They hit a bump and they don't know how to manage it. It's really simple. You do not assign a permanent credit score. If you have a medical event, you're on the wrong end of a messy divorce, job loss, whatever, you can start over. And so as soon as you start paying your bills on time again, your score starts moving up. And so, but back to length of credit history, 15%. Now, 10% is credit mix. There's 3 types of credit: mortgage, installment, revolving. When you add a type of credit that you formerly did not have, you get a 3.33% bump in your score every month. So how you manage your balances is 30%. Then you add the 3 point, that's a third. 30 plus 3.33, a third. So if you keep low balances, but back to, I think I skipped something. So if you have a $99 balance on a $100 credit card, you've got one credit card, it's $100, you got a $99 balance. Your credit report assumes that you're 2 missed paychecks away from bankruptcy. They pull credit points from you to throttle your ability to borrow until you wise up and pay it down. Then they give you those points back. Here you go. Here's your points back. Because they want you to be a borrower. They just want to get, but they also, more than them wanting to lend to you, they really want their money back. So if it looks like you've thrown a red flag, you've opened up a bunch of new credit, you've got high balances. I mean, there's several red flags that basically make the creditor frown. When the creditor frowns, you lose points. When the creditor smiles, you gain points. So when you keep your credit cards open, you don't open and close accounts. You're a bookkeeping nightmare. Seriously, think about it. You're not worth the stamp in the envelope if you're paying no interest. So now, how do we manage our credit? So if you have a $100 credit card with a $5 balance, you're at 5% balance the limit. Your credit report assumes that your debt to income is very low. So it's like, here you go, Austin. Here's some more points.
Interesting.
Yeah, and so then, but that's how they know. So you can have a 99% credit utilization 27 days out of the month if you know what day of the month your account reports on. And every account you have reports on a day. It's a software program.
Sure.
Like you don't hit a pinata and a bunch of numbers fall out and they decide that's what, it happens at the same time every month. So if you know that you've got to have your balance, if your payment is due on the 14th and it reports on the 17th, you have to have your payment made by the 15th. So that it's credited by the 16th, so it reports a low balance on a $10 balance on the 17th on a $500 card, and then you can go buy a set of tires.
Is that day easy to find?
No, not real. It is, and it should be, but it's not because.
Of course, they wouldn't want you to know it.
No, they don't care, but they don't train. Nobody's trained anymore.
Yeah.
Like if I'm trained to get you hot water, I don't know how it turns into coffee. I'm the hot water guy.
Right. Yeah.
So, that's my job. That's what they pay me to do. So you have to know that the person, and I've talked about this before, that the person you're dealing with isn't very good at their job, and it's usually not their fault. Like they don't want to lie to you. They just don't know how to not lie to you.
Yeah, sure. And it would make sense in today's setting, that hegemon company, that, why would they want to spend the extra time really to train these people to be able to answer these questions when in all reality.
But not knowing the answer doesn't keep people from answering enthusiastically.
Yeah, that is.
So you have to ask 3 questions because you're going to find out when you hit the end of their knowledge base because they're going to start squirming. And you can feel that squirm. Like, when is my payment due? You know that. When is the end of the billing cycle? You don't know that, and they probably don't either. When does my account information report to the credit bureaus? Supervisor, please. Why? Didn't I answer your questions? No. Well, didn't you hear me? Yes, I heard you.
What is and what would be the worst negative mark, I guess you could get on your credit score?
Mortgage late.
Mortgage late?
Mm-hmm.
What is there what's the thought behind that? Why would that be the worst?
Food, shelter, clothing is really important.
Gotcha.
So like if you're late on your mortgage, your whole life is in a tailspin.
So is it less about the total amount of how much they've lended you and more of like, well, this person
Payment
must
history.
not care about their home.
Or they're devolving and we've got to get in front of this. Like, oh my gosh, we're getting ready to eat this mortgage. And so then they start stacking on junk fees. You get a fee for this, fee for that, because you signed for it.
Trying to just recount for what they've invested.
Well, they're going to pile on the junk fees so that instead of your mortgage is, you got a mortgage balance of $80,000 left and you start getting late fees and all this other, they want to pack on as many junk fees so that they can, because those extra fees that they just pile on they're going to be able to take that as a loss against their profits. They're going to pay less tax.
Interesting.
Yeah, because they already knew how many people are going to default by your credit score.
Sure.
640, they know they're going to eat X number of loans. And so they're getting in front of that and piling on the fees.
Yeah.
Because if you own your own business and you've got profit on one side and losses on the other, the losses reduce your taxable income. And those are all ghost fees. Like, they didn't go out and cut your yard. I mean, they just like, you owe me this. It didn't cost them anything to pile on. Yeah. And so they're just taking advantage of people that are, in a bad situation. And they should have paid their bills. And I don't know why they didn't, but that's just what they do. Like a credit card. Before the crash in 2008, they would send you a $250 secured credit card or unsecured credit card. It'd have like $184.50 in miscellaneous fees. So when you went out and bought your dinner in $40 and you're going to pay it off, but you get your bill instead of $40, you're paying $227.50. You go, that ain't right. I ain't paying for that. Oh, don't. So now you're late. Now you're late and over the limit. And so all these fees, so a $250 credit card that they got $40 in real money in becomes a $2,500 charge off.
So what's the difference between secured and unsecured?
Secured, your collateral, when you have a car loan or a home loan, your collateral is the home of the car. Secured loan is your money is the collateral. Like if you choose not to exercise your right to pay in a timely manner, they just take your money that you prepaid for.
It's like a down payment.
Yeah, you want a $200 credit card, you're going to have at least $200 in a savings account. A lot of people charge more, like $550 to get you a $500 credit card at a credit union in Knoxville. So, but you don't need a $10,000 secured credit card. You need 100, 200. Like, I've got access to a $200 secured credit card that hits your credit report in 7 days. It's totally unbelievable. That is ridiculously fast to alter your score. Because if you don't have a credit card, you're getting ready to get a 33% bump in your score. So if you have a 300 credit score, does it become a 390? No, because your credit report adds points and it takes points in the same motion. So you might see a 40 or 50 point bump in your score if you add a credit card that you didn't have, if you had no revolving debt, but you didn't see the points that it took. So it might have added 50 or 60 points, but you only saw 40 because 10% of your score, the last part of the 100%, 10% of your score is new activity. That means that's the only true negative. Your score goes down before it goes up. You get a inquiry. That's a couple points, 2-3 points. New activity, like you get a new account, it's going to go down. But you just said if you get a credit card, it'll go up. Yeah, it'll go down, then it'll go up. You saw the points that it gave, you didn't see the points that it took.
Yeah, you might have just answered the next question I was going to ask you. I was going to say, what is the one thing, regardless of the financial situation that you're in, if you're in the credit challenge group, okay, so let's start that over. So if you're credit challenged, what is the one thing anybody could do today or put in motion today that would, in your opinion, be the best first step forward that was unilateral for, anybody?
I've said it for years. Get good credit first. If you're not going to file Chapter 7, which is a complete flush of everything, get good credit first.
So what's the one, like if I were to say, you know what, I'm going to take that step. I'm going to do something positive for my credit situation. What would be the first thing?
Email us and we'll send you a link.
That's great. Yeah, great.
It's that simple. It takes 30, 40 minutes. You fill out all the paperwork. They approve you. Your money, your $200 goes into a savings account somewhere else. And that account will hit your credit report before you get the card itself.
So in the last 60 seconds here, the company that you're with, Flender Financial Services, give a elevator pitch on what that is and how you can help.
Credit's about rules. It's about an oddly specific set of rules, and you don't know what those rules are. I do. We collectively have decades of experience under our belt in credit scores, credit lending. So you're just groping in the dark like a blind man if you don't know what the rules are.
Same reason why we hire a plumber when our pipes are
Yeah, no kidding. Yeah. You're not going to catch me getting on YouTube. Water spewing everywhere.
Yeah, well, awesome. Well, I appreciate it, joining us for this. And, it's Brian, and we're going to be going this direction a little more with what we're doing and, all things finance. So, again, this is Austin. with We're Talking Finance.